If you're wondering how to navigate government or grow your business or even secure funding for your nonprofit, then this is the podcast for you. Here on Lobbying Insider, we take a look at the intersection between business and government and show how things actually get done. I'm your host, Zack Fink, Director of External Affairs at Davidoff, Hutcher & Citron. Welcome to the program. And we are joined by Jason Harris, VP at Center Street Capital Advisors, and our own Jennifer St. Louis, partner and co-chair of Trust and Estates here at Davidoff, Hutcher & Citron. Jason, just can you give us a little bit of your background on what you do?
Sure. Center Street Capital Advisors is a full-scale wealth management firm. In addition to the investment, side of things, we do a lot of investment planning, estate planning. So we give the whole scale, full-scale approach to wealth management. Very quickly, my background prior to being on the wealth management side, I spent 20 plus years on the institutional side, ran a trading desk at a bulge bracket bank, spent about 8 years at 2 different hedge funds in between New York and London. So I decided to bring my institutional knowledge and approach to investing and risk management to individuals and families.
Got it. Okay. And Jennifer, you've been here at DHC about a year, right? And growing the trust and estates practice.
That's right. I came about a year ago from a practice in New Jersey. Now I'm here in New York, practicing both New Jersey and New York, estate planning. We handle probate administration and succession planning for folks with closely held businesses, high net worth individuals, and our team also handles guardianships and all sorts of other trust and estate matters you could think of.
Okay, great. All right. So just to give some background information, there's a couple topics we want to focus on and just see how people can use these resources to enhance their estates, plan better. Let's start with tax drag and portfolios. Tell me just broad strokes what that means.
Sure. No one likes to give away money to taxes. And in investments, taxes are always a part of the plan and thinking through how to, be as efficient as possible. So as an example, if you wanted to rebalance your portfolio, you might be selling something that has performed for you and made money, and taxes need to come out of that in some form or another, whether it's out of the investment, which therefore leaves you less to put into a different investment, whether it's out of your cash flow. So it's always a part of thinking through someone's portfolio. And I always look at different strategies to help mitigate that tax drag in people's portfolios and help them become more efficient and help create optionality.
And can you put them off or in some cases actually reduce them?
There's ways to do both.
Okay.
So very high level, I focus a lot on tax loss harvesting strategies, and there's many different out there, but essentially it allows you to maintain an investment and create a tax asset, which you can then use to offset a capital gain elsewhere in your portfolio. So examples being, you, again, want to rebalance the portfolio. There's a gain that might be associated with selling an asset. Well, now you have this tax asset on the other side to offset that liability, and it makes your rebalancing more efficient.
Because obviously you can't. You need to tax when you make capital gains, right? And if you suffer some kind of loss or there's a way to offset it.
Correct. So
Okay.
Effectively, you're creating an asset in the form of a tax asset to offset the tax liability that you've created on the other side by realizing that capital gain.
Is that a complicated thing to do, or?
There's more complicated ways to do it. There's less complicated ways to do it. So not one strategy is right for everybody. That's why there's various strategies to look at depending on people's time horizon, given their liquidity profile, things of that nature. So there's different strategies out there that help accomplish something for all different types of people and all different types of portfolios.
Now, you mentioned off the air that you're not a CPA.
Correct.
But you must have tremendous familiarity with the tax laws and the various ways to, enforce it and the various ways to tell people how it best can work for them.
That's right. From an investment standpoint, I've focused on this for a while. So no, I'm not a CPA and I'm not here giving tax advice. But yes, from the investment side of things, I've spent a lot of time understanding the nuances to create these assets and how to best use them in people's portfolios.
Got it. And Jennifer, how much of this do you need to have like kind of a grasp of in advising clients and drawing some of these documents up? I mean, do you rely on outside expertise for the most part, or I guess when you do it long enough, you start to understand the nuances?
A little bit of both. I think I understand enough of what a client needs to understand and what I need to understand. And I also understand what I don't know, right? And we'll talk a little bit later in our conversation about coordinating the advisory team. But I think this is a really good example. So, I'll have a client come to me and maybe they've inherited some assets, or maybe through a divorce they have some assets and they want to protect them for their retirement. They want to protect them for future generations. And so as an estate planning attorney, they'll come to me to set up, trusts and different vehicles where we can put assets. And that's my role. I need to get in touch with Jason or somebody, who has his expertise so that he can then look at the specific assets and decide, which type of investments are going to be good for the client. Should they be taxable now? Should they be taxable in retirement? What does that broad, short, and long-term view look like, and what are we trying to accomplish? So it's really important to have somebody like Jason on the team to have this type of expertise. And, he has an interesting niche because he was working, with where his background was, and it gave him a lot of expertise that he's now bringing to people who wouldn't ordinarily be making these types of investment choices. Maybe Jason can speak to that a little bit.
Yeah, sure. So I come from the institutional side, and my focus prior to wealth management, I invested in distressed debt and event-driven equities. So more on the alternative side of the investment spectrum. A lot of what I will look at right now will be alternative assets. So things like private credit, private equity, private infrastructure. And I think they're not easy assets to understand. And given my expertise and background of having spent 20 plus years investing in these asset classes, as well as being at these firms, I really have a deep understanding of not only the risk and reward profile of all these investments, but which managers are good to select on the alternative side, because that becomes a really paramount part of the alternative asset class ecosystem is manager selection. So I spend a lot of time looking at that and trying to intelligently incorporate those investments into people's portfolios for people who may not have looked at them in the past and might not have that expertise and that 20 plus year knowledge base of how these investments work, and how to best use them.
Now, the average person, I would think, would say that the tax code is very complicated, but obviously you're dealing not only with the federal but with the state. Would you say that it's ever evolving, meaning it might depend on the administration that's in power? Is it constantly changing? Do you then have to get up to speed every, say, 4 years on brand new laws and revisions, or is there a consistency that makes it easy to kind of follow?
Well, from my perspective, from an estate planning perspective, I would say, yes, we have to stay on top of the law and the changes, and also the changes that may be on the horizon. So with political changes, we do keep an eye on that, and we have had years where we think, based on campaign statements and what the campaign is saying that they would do if they got into office, and we don't know who's going to be elected, and we hedge our bets on which way it's going to go. We've had years where we've done a lot of planning for the just in case, and then it didn't pan out. That's not a bad thing, though, because when we're doing planning in trusts, we're building in language that's going to provide protection for the grantor, protection for future generations, but also some flexibility. So we're going to give trustees the flexibility to make the proper decisions down the road. And so good structuring of a trust is going to allow for that.
And you can anticipate, you're saying it's better to do the work and have it not pan out, but at least you're prepared for it when it comes down the pike. Absolutely.
And there, like I said, there are things that you can do, when you're drafting your trust to plan for that contingency. But it's certainly better to do the work and have it not pan out than not do it and lose opportunities.
And did you find that the tax code can be volatile, or is there consistency to it, or you can anticipate the changes well enough that it shouldn't impact too much how you approach it?
I think from an investment side of things, it seems to be steady, and we're not trying to change portfolios based on what we think might happen. That's where we rely on partners and experts like Jennifer who have a better understanding of the changes, the upcoming changes, and how to prepare for them on a planning side of things. I think that's where the bigger impact will tend to be.
Okay. I'd like to move on to charitable giving. Obviously, this is something we want to encourage everybody to do because it's the right thing to do, right? The charity of their choice. But I, from a tax perspective, from a investment perspective, like how can it impact a portfolio in a positive way in terms of offsetting potential liability? How can it be an asset?
So I think there's two things. From a family and legacy and cultural standpoint, I think a lot of people are interested in charity, and there are ways to set up structures, some more complicated, some very simple, that will allow them to accomplish that and then also help offset tax liabilities and control timing around that. So an example of that is a donor advised fund where someone can contribute or donate to the donor advised fund. Those assets can then be managed and grow. But the person who controls that has now the option of the timing of when they want to distribute those funds and to whom. So it's not that you have to donate everything in the year that you make the donation to the fund. You can, disperse that over many years, and that helps to then control how you can offset taxes. So as an example, if someone expects that they are having some form of liquidity event, a big year at work, or they're selling an asset, something of that nature, they can front load a donation all in one year to help offset some of that liability, but then spread out how they want to give that to charity over as many years as possible. So it really helps them accomplish things from the tax side, from the charitable giving side, but control the timing around all of that, which I think is really important.
That's the key thing, right? Because if you give it all in one fell swoop, it's not necessarily to your benefit. You might get hit harder in taxes that then doesn't go to the charity.
Well, it's more that if you think you're going to have a big tax liability in a year and you had a charitable giving plan already in place, just make it up. Let's just say someone wanted to donate $100,000 a year for the next 10 years. But all of a sudden they are going to have a big year at work, or they're selling an asset that's going to create a big tax liability. They can front load that donation into 1 year and say, donate $1 million to help offset that tax liability. But it doesn't mean that they have to give all $1 million to charity in that year. It is now pledged, and they can still, over their 10 years, start dispersing the $100,000 to the various charities that they want. So it helps them offset the liability in the year that they're going to have it, but still stay on the cadence that they want in terms of giving to the organizations that are meaningful for them.
And do clients even know this, understand? I mean, is this the kind of thing that you can do for them, Jennifer, where you can sort of explain that there are other options on how to do it? I understand you have this amount, you want to give it away, but here's the better way to do this.
Yeah. And what I love about charitable giving is that it's a win-win-win on so many levels. There's the financial aspect of it and the tax planning where, you're going to mitigate taxes in certain ways. And you're also going to be able to fulfill your personal, core beliefs, what's important to you, and benefit organizations that are near and dear to your heart. So I've had some clients more recently who've gotten really excited about charitable giving. So I love it. I mean, it puts me in the great position of being able to feel like I'm influencing, doing good and benefiting organizations and things and helping my clients do that. So they can do it in several different ways. They can do it during their lifetime right now for the tax reasons that we were just talking about to offset in certain years. And they can do it, I have clients who, for example, come to me and they're well taken care of financially, and they feel like not only do they want to do more, but they want to get their kids involved in doing more. Maybe they have young adult children who are educated and are just starting out in their business life, their careers, not really knowing what they want to do. It's a great way to get their kids involved in something really meaningful and to say, you know what, this is important to you. Let's set up a foundation. Let's start raising money. Let's start charitably giving. And, you know, it helps to teach the younger generations on being responsible with a great deal of money in a kind of a controlled, supervised way. So those are really exciting things. And also, when it comes to estate planning, you know, if I have a client who we foresee, okay, there could be, you know, federal tax liability, let's say, we can say in their estate plan, let's take X amount or X percentage of your estate and create a foundation with that. So instead of just paying the government and letting the government decide how it wants to spend that money, you're going to say, I'm going to put, you know, $15 million into a newly created foundation upon my death, and that foundation is going to do X, Y, and Z. Maybe it's going to lay out exactly. It's going to give to this, you know, wildlife fund or heart disease or whatever somebody wants to give to, or maybe it's going to let the trustees, who could be their children, decide. But it's a really exciting way to, you know, set up a legacy for a family and do some good.
And it would seem like there's a couple benefits to that in addition to what you're saying. Not only can a foundation, let's say it's a large number, a tremendous amount of assets, it can grow over time and continue to be able to give, you know, on a yearly or monthly basis. And in addition, I would imagine at some point you could even potentially open it up to donors. You could go beyond just the initial investment.
Oh, absolutely. Absolutely. Foundation can put on a gala every year. It can put on a, you know, any money-making event you could think of that could be, you know, the annual golf event or, you know, I'm thinking small, but yes, certainly it can just, you know, get donations from others. It can put on an event that collects money, and then those assets are used to provide, you know, scholarships, fellowships, donations to other charitable entities, or it could be an operating foundation where it's actually operating some sort of a, you know, artist in residency or whatever kind of foundation you want it to be.
And a great way to kind of endure a family's legacy, potentially, right? I mean, it's just such a great, that, you know, that would live potentially forever. I mean, not forever, but forever in terms of how we understand it in our short lives as humans, that could continue to give and be associated with one particular family or group.
Yeah. I mean, I think we all want to make our mark in history and be remembered as doing something good and have a lasting positive effect on humanity or the world in some way. And creating a foundation, you can name it whatever you want. So if it's your family name, then that can live on, you know, hopefully in eternity doing good.
Yeah. No, I mean, I remember famously as a former radio reporter that, you know, the estate of the McDonald's family, Joan Kroc, you know, bequeathed all this money to public radio. And I mean, you know, they got a handful of corporate grants and CPB money and other, but that money went a long way. I mean, now, you know, NPR is near the end here, unfortunately, because a lot of that money is gone. But, you know, it really propped it up and kept it going for many, many years and enabled it to grow in a way that it would not have been able to do so without private money. And I would imagine it was set up in some form of foundation or in terms of what you're talking about.
Absolutely.
Yeah.
And so there's a lot of, you know, donor advised funds, family foundations, operating, non-operating foundations, charitable trusts, different reasons for setting them up in different ways. But really the goal and the outcome is that it's, you know, it's a great thing to do to further a cause that's dear to you, and the financial and tax benefits are tremendous.
And it can be scaled up and down. In other words, it doesn't have to be a McDonald's estate necessarily to do good and keep giving over many years.
That's right. Yeah. It can be, you know, $1 million. It can be $100 million. It can be anywhere up and down from that.
Do you get that a lot where people, you know, want to have some sort of legacy beyond taking care of family members and making sure that there's money there? want to have some sort of contribution to society, whether it's something, charity that they prefer or something that they care about.
Yeah, absolutely. I see it on a regular basis. People want to give. Giving takes all different forms, and this is one, I think, really good way to do it that accomplishes multiple goals at the same time. But it's definitely a common theme that seems to be recurring.
That people approach and say, how can I make this so that some of my legacy goes into this thing that I've always cared about? Or
and part of my job, and I think not speaking for Jennifer, but I think part of her job is that I want to help people maximize that. So how can they help others benefit, and at the same time they're doing a great thing? How can it be structured so they can also benefit from a tax perspective as well? So I spend a lot of time thinking through the most efficient ways and the most efficient assets for them to pledge to charity, because it's not as simple sometimes as, okay, I have a lot of cash, let me put that into a foundation or something of that nature. There are ways to donate appreciated securities that can then, again, accomplish what they want to accomplish, but have a bigger benefit for them on the tax side of things. So there's all different ways to think about it, and that's what I do spend a lot of time is trying to create as much optionality and efficiency for people while they're trying to be charitable and do a great thing.
Best way to give it away.
Exactly.
Yeah, no, that makes sense. Okay, coordinated advisory teams. I'm going to need a little bit of a refresher on what this means exactly. Please tell me.
Sure. I think, advisors come in different forms, right? A financial advisor, an attorney on the trust estate side, CPA. So people tend to surround themselves with all different types of advisors. And I think everyone wants the best outcome for their client. Working together and speaking and coordinating on all different aspects of that client's life, whether it be financial or otherwise, I think gives people the highest probability for that great outcome. So always having those conversations and understanding how everyone is thinking about a problem, and I think attacking that problem collectively will get a better result than people just specifically staying in their lanes and not communicating and thinking through how to best solve that problem.
Understood about coordination, but is it better to have multiple advisors, or should people be more inclined to go with one person who they trust, who can bring in other people? What's the best way to kind of organize something like that?
I'm not so sure there's a best way. I think it's a personal thing. Mm-hmm. So I might be working with someone and I can recommend various people, and ultimately that client needs to make the decision who they think is the best person for them from all different type of fit, personality, et cetera. So I don't think there's a one size fits all. I think everyone's different and everyone wants to work differently, but there's always going to be different advisors in different fields that I think will be necessary for that client to accomplish their goals.
Give us a couple examples. Like, let's say you're trying to hash that out with someone. What different teams would you maybe potentially bring in to give them advice?
Well, I think this is the perfect example right here from an estate side of things. I'll have thoughts on what could make sense, but Jennifer's the expert. That's what she does day in, day out. I think I wouldn't be giving my client the best possible outcome if I didn't bring in that expert, right? I know my limitations, and I want to focus on what I am an expert at, and then bring in the expert in that other field and make sure we're coordinating on how we think about that. A lot of what I do on the estate side is when I work with someone like Jennifer, I'm thinking through how to maximize the structure that she might set up. So making sure the right assets go in the right structures, because Jennifer could spend a lot of time with the client, come up with this great plan, and if the wrong assets are in the wrong structures, we've kind of destroyed that plan. So I know what my role is. I know where I need to bring in that expert, and I think that's a huge part of that coordination aspect.
And do you find yourself, Jennifer, when you're working with clients, are there multiple different advisors from different facets coming in and working with you? Do you find most of the time, or is it more narrow?
Oh, I think the team approach is the necessary approach. And so if a client comes to me and they don't have a financial advisor, that's one of the questions that I ask them. And after I've gotten to know them, gotten comfortable with them, I work with, I'm sure Jason could say the same thing. I work with several great people, and I'm sure he works with other attorneys other than myself as well. And sometimes you just have a feeling for, this person's going to connect with Jason, or, et cetera. And so I'll invite my client to, reach out, and then we'll take it from there. And many times the client comes with, part of the team already in place. And of course, we work with those folks as well. I think there's two really important aspects to it. One is, the old adage of the one hand not knowing what the other hand is doing. You can't make decisions in silos when it comes to, your financial and your estate planning. They go hand in hand. So you really want your team working together. You want everyone to be knowing what they're doing. You want them to be discussing what the overall plan is going to be, because they're all going to be bringing a different perspective to the table, and they're all very important perspectives. And they all need to kind of hash it out with each other as far as, well, I need X and the other advisor may need Y. And how are we going to make that happen? I'll give you an example. From my perspective, I'm going to want to kind of lock everything up, right? Get it out of the estate so it's protected from estate taxes when my client passes away, and it goes to the next generation. But I know very well that the financial folks are going to want access to all of that during the lifetime of our clients so that they can retire in comfort, they can maintain their lifestyle. So we have to agree, what's the amount that they need accessible now? What can we, get out of their estate, but, and what can we get out of their estate, but we know they still want to access somehow. And then we determine how to structure that. And then I think the other really important point is the client needs to hear from all of our perspectives. So because we're educating the client, and ultimately it's the client that's going to make the decision or give the okay for us to move forward with this plan. So, we need to advise the client as a group. So what we do a lot of times is we'll have these conversations, then we'll schedule a meeting where we bring the client on to say, here's what here's what we recommend, here's why, you may have an option here or there. And the client that way is educated on why we came to this recommendation, and then they can make that decision for themselves and feel really confident about it.
Okay, we are coming up on time here, but I did want to ask, and this does seem, maybe it would sound simple, but I'll ask the question because it was not totally simple to me. But is the more complicated, complex an estate does that require necessarily more advisors? I mean, is that a steadfast rule, or could you have even fewer sometimes for a big estate, and the simplest of estates, for whatever reason, you have to bring in that many more people to advise?
I would say you need your estate planning attorney, you need your financial advisor, and you need a good, tax accountant type of person. And we all overlap in knowledge of all those areas, but we all need to work together. Those are your three areas you need somebody in. Yeah,
I wouldn't say more is better necessarily. I think you want to make sure you're surrounding yourself with the right people and the experts in their fields, so they are able to give you the correct advice. But complicated doesn't equate to just more people. I don't think it's the right people and making sure that you have them in place.
Makes a lot of sense. All right. Jennifer, Jason, thanks so much for being with us. We appreciate it.
Thank you so much for having us.
The Lobbying Insider podcast is a production of Davidoff Hutcher & Citron LLP, New York State's premier middle market law firm, practicing in more than 20 areas, including commercial litigation, economic development, real estate, and government affairs. The podcast is produced by Don Tesserero, and our platform manager is Monica Thomas. Be sure to subscribe, and you can get it where you get most podcasts, including Apple, Audible, Google, Spotify, and iHeartRadio. Thanks for being with us.